Hello, everyone. I am Trevor Heisler from NBC Capital Markets Advisors, and welcome to the D-Box Technologies Fiscal 2024 second quarter earnings presentation. At the end of the presentation, there will be a brief question and answer session. Before turning the call over to Sebastian Mayo, President and CEO of D-Box, I would like to remind you that today's presentation will contain forward-looking statements within the meaning of the safe harbor provisions of Canadian provincial securities laws. Forward-looking statements involve risks and uncertainties, and undue reliance should not be placed on such statements. For additional information, please consult the MD&A for the quarter, the Risk Factors section of the Annual Information Form, and D-Box's other filings with Canadian securities regulators. D-Box does not undertake to update any forward-looking statements, and such statements speak only as of the date made. I'd also like to point out that all dollar amounts in this presentation are in Canadian dollars unless otherwise specified. I will now turn the presentation over to Sebastian. Please go ahead.
Thank you, Trevor, and hello, everyone. We reported our fiscal 2024 second quarter result on November 9th after market close. Our news release, financial statement, and MD&A can be found on our website at www.d-box.com and have also been filed on SEDAR+. We achieved a new quarterly record for revenue as total revenue increased 77% to 10.9 million. System sales grew 99% to 8.7 million, largely due to a 2.3 million increase in sales to theatrical customers compared to Q2 of last year. During the quarter, we completed a purchase order from Cooler Master, delivering 1 million in haptic system for their Motion 1 gaming chair. Our rights for use, rental, and maintenance revenue increased 21% to 2.1 million, mainly due to our large footprint in theaters compared to the prior year. This was another quarter of profitable growth for D-Box. Our gross profit excluding amortization nearly doubled to 8.7 million, thanks to our incredible revenue growth. However, gross margin excluding amortization decreased to 48% from 54% a year ago due to differences in our product and market mix compared to the second quarter of last year. This year, we had a much higher proportion of revenue coming from system sale, while rights for use, rental, and maintenance revenue generate higher margin for us. Adjusted EBITDA for the quarter increased to 1.1 million compared to 38,000 a year ago. Our adjusted EBITDA margin improved to 10% of total revenue from 0.6%. We had a net profit of 400,000 compared to a loss of 700,000 this time last year. Looking at our result on a trailing four-quarter basis, we had total revenue of 42.2 million, which was the highest for any four consecutive quarter in our history, surpassing the prior record of 37.5 million we just reported a few months ago. Importantly, the higher revenue again resulted in stronger profitability. Over the last four quarters, we had adjusted EBITDA of 3.5 million, which was an increase of 72.9% compared to the trailing four quarters ended September 30th, 2022. Looking at our result for the first half of fiscal 24, our total revenue of 21.3 million are 61% higher than at the halfway mark of our last fiscal year. And our adjusted EBITDA of 2.3 million for the first 6 months of fiscal 24 is 265% higher than in the first 6 months of last fiscal year. While our financial result for the first 6 months of fiscal 24 have us on track to surpass our fiscal 23 full-year revenue and EBITDA figure, we do expect a softer second half to fiscal 24. As I'm sure you are aware, the work stoppage in Hollywood this year, even if not over, have caused delays for many movies, and we are seeing an impact from this. For one thing, we don't currently expect any clear smash hit movies for the holiday season, unlike last year, which had the Avatar and Black Panther sequels. Additionally, some customers may scale back or delay order due to the uncertain economic condition we are seeing, including inflation, recessionary fears, and higher interest rates. First, let's take a quick look at theatrical, where D-Box is renowned for collaborating with cinema partners around the world to provide premium haptic theatrical experiences to moviegoers. In the second quarter, we added 23 net new system screens, bringing our total footprint to 879 screens at the end of September. We remain focused on strengthening our leadership position in this market and expect to reach 1,000 total screens within the next 2 years. Moving on, D-Box is reaffirming its commitment to being the best and most realistic haptic experience provider in the sim racing sector. Post-quarter ends on November 2nd, we announced a partnership to bring our haptic technology to Playseat's sim racing chassis and flying simulation cockpits. Playseat is a leading global manufacturer of racing chassis and flight simulation cockpits. The Playseat D-Box motion platform has been specifically designed to integrate our actuators and will be available to Playseat global reseller network in the coming weeks. Finally, we are gaining momentum into professional simulation and training. We have an established presence in this market and look to capitalize on growing demand. We are trusted by the best partner, collaborator, and client in the professional simulation and training industry around the world to create high-performance training simulators that provide a complete sensorial experience. We had strong contribution from simulation and training in Q1 and again in Q2. In fact, our year-to-date simulation and training revenue is up 118% to $5 million, including $2.1 million in the second quarter. Importantly, the simulation and training market is estimated to grow 10% per annum to $20 billion by 2027. The market is supported by strong fundamentals driven by safety and prevention measures, increased skills and productivity, and cost saving compared to training on trucks, planes, helicopters, and heavy equipment. Additionally, training on simulators equate to a lower environmental footprint. From driving and flight simulators to heavy vehicles, construction equipment, and more type of professional simulated training, D-Box haptic motion creates maximum engagement for trainees with minimal risk of damage to equipment. Moving on to our outlook, our strong financial results for the first half of the year have us on track for beating last year's financial result, but as I said earlier, we are expecting a softer second half. Nevertheless, we continue to see significant potential for growing our worldwide installed base and industry-leading haptic ecosystem. As always, we remain focused on expanding our recurring revenues and delivering profitable growth. Finally, we continue to monitor potential risk from geopolitical issues, inflationary pressure, and supply chain constraints. And we are monitoring the Hollywood labor dispute impacts to see how they will influence the release of movie, our right of use, and the short-term financial situation of exhibitor. On that note, I would like to take the time to answer some of the questions submitted by our investor. I will ask Trevor Eisler from MBC Capital Markets Advisor to raise the question for me. Please go ahead, Trevor.
Thank you, Sebastian. The first question that we received was, what kind of sales do you expect from the Motion One gaming share this year?
As you know, we don't provide guidance at this point. The response and review of Motion One have been favorable so far, but as we said previously, this initiative was to position D-Box haptic value in the gaming ecosystem. It is a premium product that targets early adopter on the consumer side and with more applications on the commercial side.
Thank you. And a follow-up question on Cooler Master. Cooler Master has already increased the price of the Motion One to $2,500 from $2,200 on its website. Assuming this is due to higher input costs and not excessive demand, is it reducing your revenue forecast and/or profit margin on sales to Cooler Master?
This price increase was part of the initial strategy. It was decided from the start that there would be a launching price and a subsequent price that would be the $2,500 we are talking about. and it doesn't change negatively or positively the gross margin for D-BOX.
Okay, thank you. How much revenue did you receive in the quarter from the Vibe Chair, and what can we expect in terms of an annual revenue contribution from this product?
I'm really proud that we have delivered the Vibe Chair to the consumer during the summer. The strategy to launch through the Indiegogo crowdfunding platform was done to maximize user and buyers' inputs, and we are happy with the overall learning from this project. Revenues from this initiative were not significant, but it will help D-BOX in the future to better suit the needs for consumer solution and help our strategy with potential reseller partners. As for the expected annual revenue from the Vibe Chair, again, we don't provide guidance.
Okay, our next question. When are the Birmingham and Boston F1 arcade locations expected to open, and what kind of revenue do you expect from each?
Venues in Birmingham and Boston are expecting to open within the next month. As Birmingham is set before the end of current calendar year, and Boston the first half of calendar 24. The first F1 arcade location in London continued to be well received, and the partners are happy with the occupancy level supporting the opening I just mentioned. Overall, 30 locations are planned over the next 4 to 5 years, each with 60 simulators. We don't provide forecasts, but as I already said, this rollout is a potential multi-million-dollar contract for D-BOX.
Great, and it looks like our last question is, congratulations on the strong adjusted EBITDA for the quarter. Should we expect similar EBITDA margins going forward?
As we have said on multiple occasions, our focus is on delivering profitable growth, and that includes improving our profitability. Our adjusted EBITDA margin for the quarter was 10% compared to 0.6% last year and 5.2% for the full fiscal 23. While we expect a softer second half and we need to manage economic uncertainty, we continue to target higher EBITDA. Our goal is to improve to an annual 10% EBITDA margin, but we are a growing technology company and we continue expanding in multiple strategic markets.
And that's all the questions that we have, Sebastian.
Well, Trevor, thank you a lot for your time. For all shareholders, thank you for listening to that webinar. And as I'll finish on that, as we say, we'll always be focusing on two things, the growth on the top line and definitely improving the profitability for the sake of all stakeholders. Thank you a lot for your support.